The Magnificent Seven, powered by the AI boom, have propelled markets to new record highs. We just got NVIDIA's announcement of an investment of up to $100 billion US in OpenAI. Is this an example of just circularity, where NVIDIA is effectively funding the purchase of its own devices? We're joined by Christine Tan, Portfolio Manager at SLGI Asset Management. Great to see you.
Good morning. Good to be here.
Without commenting specifically on NVIDIA and OpenAI, are you worried that there's just too much investment being announced in this sector right now?
It is a little bit interesting that all the investment that we've seen so far has been self-funded. So if you look at Microsoft, the Metas of the world, they're paying for these chips and they're actually forming a business model around it. OpenAI actually do have a strong model, obviously, ChatGPT. I use it, but it's notable that here you have the seller of the chips actually investing in a potential or a customer in order to create demand for its own chips. So we'll see how that plays out. But if you would have thought that with the demand for ChatGPT, if it was as strong as we thought it was, there should have been capital available elsewhere.
We've got this strange development in technology as well, whereby America is restricting sales of technology to China. And we've heard talk that we might get this bipolar world where there's two separate tech universes.
Yeah, it's so up until now, it's been mostly noise around the Trump administration restricting NVIDIA chips. So actually, Biden did the same thing and potentially levying a high-level tariff, if you will, on chips being sold to China. But then China recently just announced that they're telling their companies not to buy NVIDIA chips. And actually, on the same day, Huawei announced a new generation or next generation AI chip as well. So to your point, Andy, I think there is this kind of bipolar AI world that's maybe emerging. It's not that it's emerging, it's been there kind of percolating, but there is very much this competitive tension between the two major players in the world.
Yeah, I mean, you make a point. This is not that new a scene, because Huawei, quite a few years ago, was banned from telecom systems in countries including Canada.
Correct.
Sectors that you prefer right now include staples and healthcare. So you're being a bit defensive?
Yeah, so we have a sector rotation model that sort of takes in a lot of different data, macro data as well as market data. And for the month of September, it does have a preference for some of these more defensive sectors like staples, healthcare, you've got real estate in there, telecommunications, and also materials. So the materials piece, we've seen how well gold has done. You and I have talked about the spectacular run that gold has had year to date. And it is sort of a bit of a defensive play in that central banks continue to diversify some of their dollar exposure, and gold can be seen as a bit of an inflation hedge. And maybe if the Fed were to start on this cutting cycle that the bond market seems to be pricing in, that could be a positive for gold as well. So you're right, it is a bit of a defensive tilt. And these sectors typically trade at a lower relative valuation as well. So that adds to that relative defensiveness.
And are clients telling you we want more gold, or do you have any sense whether there's more optimism over bullion?
Well, clients are not necessarily asking us for specific sectors of gold exposure. They're actually asking us how we're positioned. And we've been talking about gold as sort of that defensive inflation hedge since really late Q3, Q4 last year.
It's interesting how American stocks are up this year, but they've lagged a lot of markets, including Canada.
That's right. And you sort of started off by saying how Mag 7 has had a nice little recovery as well. About 3 weeks ago, Mag 7 actually started outperforming year to date, at least the S&P 500. But even with all of that performance, the S&P is lagging the TSX. It is lagging the major European indexes. And also, if you look at China, the China markets have been very strong year to date. And part of that was we'd sort of talked about coming into this year being more diversified geographically. And our call was based on relative valuations being more attractive, ex-US, and also just earnings starting to recover and broaden out. And that's a good thing. As an investor, you want to see that broader base of earnings growth, and you want to see a broader sort of participation in this equity rally that we've seen.
Maybe we could put up a 5-year comparative chart between the S&P 500 and the TSX, because crunching numbers yesterday, it looks like over 5 years, if you include dividends,
yes,
the TSX has caught up with the S&P 500.
That's right. And that's something a lot of times we don't notice because we've been sort of so focused on the Meg 7 and stock specifics. But yeah, Canada, as you said, Andy, has actually held its own.
Yeah, and I guess our market, well, by its nature, we've got these big yielding energy companies and,
Correct.
of course, banks. We've got a high yielding market.
Correct. We do typically, our sectors are a little bit more cyclical. They do trade at a slightly lower valuation than the S&P 500. We've certainly benefited from how well gold has done because the materials sector is a big component of the TSX.
Are you guys interested in real estate as a sector now with interest rates apparently coming down?
We have a allocation to real estate within our real asset fund in our solutions. And our strategic asset allocation model actually did increase that real estate exposure for this year. Just a tad.
It is interesting. I know this is a little off topic, but we've heard a lot of talk about private investing, but we've also seen quite a few mortgage/real estate funds, as you know, restricting withdrawals because of liquidity challenges.
That's right. So there is a difference, to your point, Andrew, between what's happening in the mortgage market, because clearly, even though the Bank of Canada has been cutting, rates are still significantly higher than where it was during the pandemic lows. So you are seeing stress, especially as these mortgages are rolling over, versus real estate. The REITs, they tend to be, there are some multi-residential REITs in there, but you're talking much more diversified base as well. So certainly a beneficiary of lower rates, more so for the REITs as opposed to the mortgage market.
Thank you very much, Christine.
Thank you. It's good to see you.
Christine Tan, Portfolio Manager at SLGI Asset Management.